Chocolate chippy disclaimer number 1. This post includes brief references to public tax commentary, published financial strategies, and educational insights from respected figures such as Tom Wheelwright, Robert Kiyosaki, Cardone, and Kerry Packer's public testimony. It also contains short lyrical quotes, song references, and movie mentions used solely for educational, reflective, and humorous purposes. No full lyrics, audio tracks, or commercial use are intended. All rights remain with the original creators. This content is shared in good faith for learning, legacy, and emotional storytelling. Please seek licensed permission for any extended use, reproduction, or performance. Today, let's have a squiz into the tax code, your blueprint to wealth. The one thing the tax code is not is a trap, okay? So today's chocolate chippy special is spaghetti and corned beef over rice with 2 eggs over easy. So here we go. It doesn't matter where you live in the world. Any tax system tells you how not to pay tax. Say what? The sad truth is, the majority of accountants live in fear of the tax department. The tax code isn't a punishment system, it's a roadmap. Or a roof index for the people in the back. The government is telling you where they want you to put your money. Get the hell out of here. Nah, man, listen. From property, energy, investing in medicine to building businesses, it's all incentives. Incentives? What is that? Okay, in the tax code, there was a thing called tax incentives, right? Tax incentives are legal rewards built into the tax code to encourage behavior that benefits society. They are not loopholes. They are government-approved strategies that say, if you help us solve a problem, housing, energy, jobs, medicine, we'll help you pay less tax. You scratch my back and I'll scratch yours. You feel me? Every country does it. Okay, Tokyo, South America, Australia, the US, France, Germany, UK, Africa, calling out around the world. Are you ready for a brand new beat? You get my drift. They all use tax codes to guide money towards national priorities. Why governments use incentives? Because it's cheaper to reward citizens than to fund everything themselves. Instead of building every rental home, hospital, or solar farm, they say, you build it, we'll give you a tax break. It's a partnership. You invest in what society needs, they reduce your tax bill. Just remember, government actually has no money. It's all our taxes we have to pay. Remember, nothing is for free, baby. Tom Wheelwright, Tax-Free Wealth, says it best. Everything you've ever learned about taxes is wrong. The tax law is a series of incentives that can make you rich. That's what I'm talking about. The book's message is crystal clear. Governments don't want to rob you. They want to guide your behavior through tax breaks. And then there's the legendary Kerry Packer in Parliament, famously pushing back. Remember? I am not evading tax. I am minimizing my tax. If anyone doesn't minimize tax, they want their heads read. These voices matter because they expose the truth. When people say, you can't do that here, you should answer, no, you can't. Use the system smartly. It's not shady. It's strategic. Look at the game Monopoly. It's the perfect game for teaching anyone how to accumulate wealth. You buy one house, then buy 3 houses. Now you can buy a hotel. Next move is to buy businesses on the board. When someone lands on your business, it's a show me the money. They have to pay you for landing on your business. And there's Robert Kiyosaki, Grant Cardone, Ken McElroy, and all the big business minds. What do they preach? You don't get rich despite the tax code. You get rich with it. How I like to put it is, you get in bed with the government. So a tactical breakdown is, the strategy is to do what the system encourages you to do. Yes, invest. Invest in housing, and you get to use negative gearing. Remember, rental losses reduce your taxable income. The problem is, most accountants play it safe. They won't run the depreciation game like a battle plan. So here we have the tax-free wealth mind game. Let's say, for example, you bought a house for $500,000. Today, it's worth $1 million. You refinance at 80% of current value equals $800,000. You use the new loan to pay off the old mortgage, which is the $500,000 loan. And guess what? Are you ready for this? You get to pocket the difference, which is a cool $300,000. Are you serious? Yes, as serial as wheat books. So, is that $300,000 tax-free, you ask? Yes, and this deserves the yippee-ki-yay moon. If it's your principal residence and the funds are used for personal purposes, here's why. You're not earning income. You're borrowing against equity. The ATO does not tax borrowed money. You're already paying interest on the $800,000 loan. That's your cost. $300,000 is not income, it's debt, and debt is not taxable. In Australia, refinancing your home loan to access equity does not trigger tax. If the funds are used for personal use, example, renovations, paying off other debt, investing in non-income generating assets, which are like a boat, a car, a holiday, even a watch or artwork. If it's not rented or sold for profit, these are considered private use, so the ATO says no deductions for interest. Just calm your farm, people. This is not some kind of hoax. But when is it not tax-free? If you use the $300,000 to buy an investment property, fund a business, generate income, then the interest on that portion of the loan may be deductible. Okay? But the ATO will want to see how the funds were used. So 1 minute you're staring at your mortgage, next minute you're holding $300K, tax-free, and you're wondering if the ATO's asleep at the wheel. But it's not a loophole. It's the system working exactly as designed. Governments want you to build wealth through housing. They incentivize it. That's why refinancing to access equity isn't taxed. Because it's debt, not income. You're already paying interest to the bank, so the ATO doesn't double dip. It's like saying, here's your house, it grew in value. You borrowed against it, you're paying interest. We'll leave you alone. The tax code isn't just rules, it's a blueprint for wealth. Still tuned in? Well, there are only 3 incomes in the world. What I mean is, number 1, earned income. This is your job, your wages, your hustle, salary and contractor payments, taxed at full rates, up to 45% in Australia, plus 2% Medicare levy. You work, you get paid, the ATO takes a slice. And standing at number 2 is portfolio income. This is stocks, crypto, ETFs. If you sell at a profit, capital gains tax applies. Now, there is a tax plan when it comes to stocks and the like. It's a tax-free liquidity game. So you use your stock holdings as collateral. It's called the buy, borrow, die strategy. And it's one of the cleanest wealth plays on the planet. So you get the buy. Let's use Elon Musk. So Elon Musk owns billions in Tesla, SpaceX stock. He doesn't sell it because selling triggers capital gains tax. Then we have number 2, the borrow. He takes out massive loans using his stock as collateral. These are called securities, backed lines of credit. He gets cash but pays no tax. Because remember, loans aren't income. Yeah, take a breath. You okay there? Then number 3 is the die. When he eventually passes away, his heirs inherit the stock with a stepped-up cost basis. This means all the unrealized gains are wiped clean. No capital gains tax owed. Yes, the rich get richer. Yes, there is a wealth gap. This is just reality. But why it's all legal? Remember, debt is not taxable. The ATO or the IRS only tax income or realized gains. Remember, you are paying interest on the loans. That's the cost for you. And the tax department don't double dip. Now we come to the winner chicken dinner, passive income. This is rental income, dividends, royalties, and a refi game. Here's the magic. You buy a house for $500K, that's now worth $1 million. You refinance at 80%. Now you have $800,000 loan. Pay off old loan, $500,000. Pocket $300,000. Tax free. These 3 words when you're getting busy, and whoop, there it is. Hit me now, whoop, there it is. Come on, whoop, there it is. Why? because debt is not income. You're borrowing against equity. The ATO can't tax borrowed money, and you're already paying interest to the bank. That's the refi game, baby. It's legal, powerful, and used by the wealthy every day. Even though the stock market game is the cleanest on the planet, real estate still wins because it's in the name for a reason, because it's real. You can touch it. When the stock market crashes overnight, your house doesn't just vanish into the thin air. Property is less volatile, more resilient to market shocks. Rental income is consistent, while dividends can be cut. You can leverage property safely. Banks lend against it at 80% LVR. And you have control, location, renovations, tenant selection, management, and as the famous king said, etc., etc., etc. So the government rewards asset wear and tear through what they call depreciation. It's the ATO's way of saying that thing you bought is wearing out, so we will let you claim a little bit of its cost each year. You just need to own something that loses value over time. The big picture, the tax code is a roadmap to wealth. The system invites smart plays. You can be brave and legal with property, energy, trust, structures, super, and smart timing. Every person you know who are wealthy did not get wealthy by accident. They used the system. And it's all legit. Too legit to quit. Too legit. Too legit to quit. You feel me? If you are wondering, you can't do that here. The reply you will get is no, you just can't. Every government tax code, ATO in Australia, IRS in the US, reward you when you spend money in ways they want: charity, housing, super, energy, jobs. If you donate, invest, or spend in those areas, you lower your taxable income. You get it back at tax time. It's like the ATO becomes a forced savings account. You park the money there all year, and they refund it when you lodge. So you can start as little as $5, like to a charity, as $5 a week. So $5 a week equals $260 a year. The charity must be ATO registered. So at tax time, if you earn $50,000 to $100,000 of income, your tax rate is 30%. You get back $78 of that $260. But here's the twist. You earn $200,000 income and your tax rate is 45%. You get back $117 of that $260. Translation: the higher your tax bracket, the bigger the refund for the same donation. And that goes for any investment. Yep, the rich don't get rich because of loopholes. They just buy more deductible assets like property, business, and energy projects instead of letting the ATO take their cash. So you are going to use the ATO as a piggy bank. The tax code is literally the government saying, spend here and we will reward you. Or, as I like to put it, the government doesn't want you to be poor. Not when they are literally telling you to use tax incentives to not pay tax. And it's 100% legal beagle. If you are wondering why am I doing this, it's because I am no ordinary man. And this is my purpose, and to honor my beautiful boy, Amra. If this mission aligns with you, should you accept? Come, let's build this together. Thank you for the likes. Thank you for your time. So come and get some. Chocolate Chippy, disclaimer number 2. I am a qualified builder with 25 years experience. Where I'm from, they call me Chocolate Chippy. I am not a financial advisor or a tax agent, and I'm not affiliated with any company. This is not financial advice. All data and figures are based on public information and are for my personal use under the Adune Foundation's housing mission. So please seek licensed legal, financial, or tax guidance before making decisions.